Hey guys, welcome back to another video. Today I will be talking about the impact of leases in valuation. And this is quite an important topic, especially if you're going into investment banking or equity research, because a lot of the time in the more advanced interviews, you will be asked something with regards to operating and capital leases and how it impacts the financial statements of the companies that you are analyzing. And so this is a topic which, when I was preparing for my investment banking interviews, I saw not a lot of content available on YouTube, and so that's why I really wanted to publish these few videos. This is part one of three. In part one, I will be talking more of taking on more of the accounting side of the discussion, and in parts 2 and 3, I'll be going into the actual adjustments that are necessary in order for you to account for them in your financial analysis. I would recommend that you really spend time on this video, because if you're able to understand the difference between an operating and a capital lease, then the adjustments are much easier to understand. So hopefully you can watch all three of the parts, and then you will be able to fully understand the topic. So let's get started. So there are two types of leases. There's an operating lease, which is an agreement signed for a period much shorter than the actual life of the asset, while the present value of lease payments are generally much lower than the actual price of the asset. And then there's a capital lease, which is an agreement which generally lasts the entire life of the asset, with the present value of lease payments covering the price of the asset. Oftentimes it cannot be canceled, and it has an option to buy the asset at a favorable price. Now, a lease is considered a capital lease if one of these holds true. The life of the lease is at least 75% of the asset's life. 2, the ownership of the asset is transferred to the lessee, the person using the lease, at the end of the lease. 3, there is a bargain purchase option whereby the purchase price is below the expected market value. And 4, the present value of the lease payments exceeds 90% of the initial value of the asset. Okay, so if any of these four are true, then that lease is considered a capital lease. Now, the key is to determine whether the ownership of the asset in a lease resides with the lessor, the entity offering the asset, or the lessee, the entity using the asset. So if it is the lessee, then it is considered a capital lease. But if ownership resides with the lessor, the person who offers this lease, then it is an operating asset. And so besides the points that we've already talked about, I think the important one is for a capital lease, the lessee would pay the related insurance for that asset. So a good indicator is if the company is paying related insurance, then it would be considered a capital lease. Okay, so let's look at an example, and this is actually an example that was used in my investment banking interview. So you are an investment banker and are comparing two airline companies that both operate with 3 planes. WestJet leases their planes while Air Canada buys them. How do you compare these companies? So to illustrate how the lease versus own or capital lease example impacts the income statement of these companies, let's build a quick income statement. So on the left, you have the income statement of WestJet, which leases its planes, right? So revenue, COGS, and gross profit and operating expense, they're all the same for each of the companies, right? So you have revenue of 150, COGS of 40, gross profit of 110, and then operating expense of $40. So everything up to there is the same between WestJet and Air Canada. But WestJet, because it leases its planes, reports a lease payment, a rental expense of $10. Whereas with Air Canada, which owns its planes, they do not pay a rental expense, so they report zero over there. So from an EBITDA perspective, the EBITDA of WestJet is $60, where the EBITDA of Air Canada is $70. And so when you're talking about comparing two companies, usually EBITDA is the cash flow metric that a lot of analysts like to use because it is unbiased with regards to capital structure. But with operating leases, it distorts that EBITDA measure. And therefore, that's what, with that whole adjustment process, that's why you're watching this video. You have to understand how to adjust and account for that difference so that you can really use that measure to compare companies. Right now, it's not an apple-to-apple comparison. It's not a fair comparison because later on, Air Canada reports their depreciation charge of the same amount, whereas there is no depreciation charge with WestJet because it's an operating lease. Okay, so in finance, our view of all leases, operating as well as capital, is colored by whether the lease payment represents a commitment similar to interest payments on debt. If the answer is yes, leasing becomes an alternative to borrowing and buying assets. Lease payments then become a financial expense, which is above EBITDA. So if ignored, the EBITDA measure does not truly reflect cash flow available to all capital sources, equity plus debt. So right away, a multiples analysis is skewed if you don't make this adjustment. And I just want to say this right now. So what we're talking about is the capitalization of leases. So you talk about how, in this example, this operating lease distorts the EBITDA metric, and the capitalization of a lease essentially means that you're taking this capital lease, this operating lease, and you're converting it into a capital lease, and therefore you're taking this expense and reporting it as depreciation, right? And also imputed interest, which we'll learn later on, right? So you're converting a operating lease into a capital lease to then compare WestJet and Air Canada fairly. So that's the adjustment that you're making. And so we're going to learn about how, in accounting terms, that is done, okay? So most valuation models start with the after-tax operating income as a measure of the operating income on a firm and reduce it to free cash flow for discounting purposes. And using this measure of earnings, operating expenses include only those expenses designed to create revenue in the current period, and they do not include any financing expenses. So when we calculate our unlevered free cash flow, we start at EBIT. We take away taxes. We then get NOPAT, net operating profit after tax. You then take away changes in net working capital and CAPEX and add back depreciation for your unlevered free cash flow. Okay? The thing with that is, when you're starting at the EBIT measure, if you have not capitalized any operating leases, what happens is that your EBIT is going to usually be lower than what it should actually be, and therefore your free cash flow will be undervalued. It will be underreported, right? And so that's why you want to account for that. That's the importance of the capitalization of an operating lease. So the effects of leasing an asset will depend on how the IRS and GAAP standards categorize the asset. Lease arrangements also allow firms to take assets off balance sheet and reduce their leverage. Leases are sometimes a source of off-balance sheet financing, and this is important because a lot of companies want to use operating leases rather than capital leases because they don't have to report the liability on their balance sheet, and therefore they can appear under leveraged even though they might be using a lot of capacity that it needs to be supported by these leases, right? And so if you're under reporting that, it can be a little deceitful to investors, right? So that's why there's a lot of rules and regulations surrounding operating and capital leases. Okay, so from an effect on expenses, income, and taxes, an operating lease, the lease payment qualifies as an operating expense and is tax deductible. It reduces income, which provides a tax benefit, and it is similar to interest payments on debt, a cash outflow which creates a tax benefit. And so the after-tax effect on a lease of a lease on net income is the lease payment times 1 minus the marginal tax rate. Okay, so essentially what you want to take away is that an operating lease, the lease payment is an operating expense. Okay, for a capital lease, leases are treated similar to assets that are bought by the firm. So a firm claims depreciation on the asset rather than for an operating lease, a operating expense, and the firm claims inputted interest payments on the lease as tax deductions rather than the lease payment. And this is important. So there are 2 charges for capital leases, and there's 1 charge for an operating lease. So the 2 charges are the depreciation and the inputted interest payment. Okay, so inputted interest expense. It is the interest that is considered by the IRS to have been paid for tax purposes, even if no interest payment was made. It is a tool to collect tax revenues on loans that do not pay interest. It is assumed that the lease payment is a debt payment, and by apportionating it between interest and principal paid. And so we're going to look at an example so that we can really see how accountants, charge these 2 charges, right? How they calculate these 2 charges, depreciation and input interest. So consider a 5-year capital lease with lease payments of $1 million each year. The pre-tax cost of debt, the discount rate that we'll use, is 10%. So we're going to find the present value of the lease liability. We'll then calculate the depreciation schedule, and then we'll calculate the inputted interest expense for each year. Okay, so this will be the schedule that we're using. So let's look at the first one. We need to calculate the present value of the lease liability using the PVIFA formula, the present value interest factor annuity formula. And so we have the 5 $1 million payments each year. So this is the PVIFA formula. we have the $1 million payment, which is the annual, the annuity in this case, the present value factor annuity, right? So the annuity payment would be $1 million. And then we insert the 1%, the 10% charge, the interest charge, and the 5 years, right? And so the present value of 5 $1 million payments across the next 5 years in today's terms would be $3,709,787. So that is the present value of this lease liability. It's the value of this capital lease, right? And so that's where we reported right here. Now we want to calculate the inputted interest and depreciation. So let's calculate depreciation first. It's relatively easy because we can just assume that based on the present value of this operating asset, of this capital asset, we'll assume straight line. So we just divide the present value of the liability by 5 to get a depreciation charge each year of $758,157. Okay? And so we can put that into our schedule right over here. And then we go on to calculate the inputted interest. To calculate the interest expense, multiply the pre-tax cost of debt, which is 10%, by the remaining lease liability in each period. So in the first year, we have the existing lease liability of $3,790,787. We multiply that by 10% to get our inputted interest expense in year 1 of $379,079. Okay? The difference between the $1 million lease payment and the inputted interest is what the lease liability falls by each year. It is the reduction in lease liability. So let's put this into the schedule and once again talk about it. So our inputted interest expense would be 10% of the present value of the lease liability in the current period. In year 1, it would be the present value of the initial lease capital lease, right? So we multiply 10% by the PV. And then the difference between the $1 million lease payment and the inputted interest expense is the reduction in the lease liability. So then we take that number and we subtract it from the $3.79 million to get the remaining lease liability after 1 year. Okay? And then if we sum up the depreciation charge plus the inputted interest expense, that is the total tax deduction that is reported for this capital lease, right? And that's important. So essentially there are two charges with the capital lease. There's the inputted interest and lease liability. And so that's the total tax deduction with regards to the first year. And now we can calculate the remaining year, right? The remaining 4 years. So let's try year 2. I know there's a lot of numbers, but let's go through it, right? So we have an existing lease liability after 1 year of $3,169,866. We then multiply that by 10%, that pre-tax cost of debt, to get an inputted interest of $316,000. The difference between $1 million and $316,000 is the reduction in lease liability of $683,000, and then we subtract this from the remaining lease liability in year 1 to get the remaining lease liability in year 2, at the end of year 2, of $2,486,853. Right? And as always, you have the straight line depreciation charge of $758,157. We then add this charge with the inputted interest charge to get our total tax deduction in year 2 of $1,755,144. Now, a cool trick is that if you add up all these things, you'll get the $5 million initial charge, right? So 5 times $1 million lease payments equals $5 million, and if you add up the total tax deduction, it sums up to $5 million, okay? And that makes sense. So the net effect on EBIT, so from an operating lease perspective, there's an operating expense of $2,000, in this case $2,000, and so that is reported before EBITDA. So that is reported as an operating expense and it impacts EBITDA, whereas with a capital lease, there's no charge which impacts EBITDA. So therefore, EBITDA would be higher in a capital lease than a operating lease scenario. With the capital lease, there are two charges. There's the depreciation and the inputted interest expense. So depreciation is charged after EBITDA. And even with that, the EBIT charge is significant or higher for the capital lease company than the operating lease company because only one of the two charges has been charged. After EBIT, only then is the inputted interest reported, and therefore income before tax is when, in this scenario, it would be equal. Now, Usually there is a trade-off. The rental expense is higher than the depreciation and inputted interest expense combined. I did it for simplicity's sake to equal 2,000 each. But in the real world, because people demand operating leases and prefer operating leases over capital leases because it's a off-balance sheet funding source, the rental expense is usually higher than the combined depreciation, input, and interest expense, right? And then, so in that scenario, the numbers would be a little bit different from this example. Okay, so for an operating lease, the asset is not shown on the balance sheet. For a capital lease, the leased asset is shown on the balance sheet with a corresponding liability capturing the present value of the expected lease payments. This is why firms prefer operating leases. It understates the financial leverage the company has taken on. So recall the previous inputted interest example. This was a schedule that we just looked at. Let's see how this is reported on the balance sheet instead of the income statement, right? So we take the first year. So we have our initial present value of the lease liability, right? So this would be the value of the capital lease at the first year. And we have the interest expense, the reduction in lease liability, the lease liability itself, and depreciation. And so from the asset side, the value of the leased property initially at year 0 is the present value of the lease liability of the $1 million payments. So it's $3.79 million, right? And then we can subtract the accumulated depreciation year 1 with the straight line method to get the net asset value. And then from a current liabilities perspective, we have interest payable, the inputted interest, plus the lease liability of $620,921. And then we have the lease liability, which is the remaining lease balance, so the 3.169 million, which is after. So that's the non-current liability. That is the standing liability left on that property or that capital asset, okay? So if lease payments are viewed as a commitment similar to interest payments on debt, lease payments become financial expenses rather than operating expenses. We already know that. Several different adjustments can be made in order to account for the respective company's lease agreements. And so in video 2, part 2 of this series, this is what we're going to talk about. We're going to cover the capital adjustment, the income adjustment, the profitability adjustment, and the free cash flow adjustment, which all account for that capitalization process of converting an operating lease into a capital lease in order to make the comparison between two companies like Air Canada and WestJet fair when we are conducting a financial analysis. So if you have any questions, please do comment below. If you did like this video, please like and subscribe, and check out part 2 for these 4 adjustments. Take care, guys.